Evening, everyone. Thank you so much for joining me and Christine here, the 2023 Member Summit event. I'm Daniel Hatch. I'm Director of Commercial Lending here in our primary markets for BECU. My team covers all the way up to Bellingham down to Vancouver, Washington. I have a counterpart, Steve Hoschild, who handles our everything from Central Washington over into Idaho and then down into Oregon. So I've been in commercial banking since about 2006. I've been at community banks, Sterling Savings Bank, now Umpqua National Bank. I was at Bank of America for a number of years, and then most recently here at BCU. And this is my first venture into a credit union that I've been a part of, and I'm really enjoying the culture and connection with our community. And this is an example of that. So I've worked on both the credit side as well as the production side. I've been leading sales teams for about 10 years, and currently I lead a sales team here at BCU of 4 relationship managers. And like I said, in our primary market here. So I want to start off my discussion, or my part of the discussion, with a quick overview of the economy and some of the contributing factors to the uncertainty that we're experiencing in the financial industry right now. So I want to get into that. And then I think Christine Buckley from Business Impact Northwest will do a deeper dive into some of the more specifics around principles of commercial credit, as well as what to prepare when seeking a loan. During this time, your mics will be muted, but you can put any questions that you have in the chat, and we'll have time to address those during our Q&A session at the end of the presentation. Okay, let's get started. All right. I think we're on. I think we started at the back here. Right? Sorry about that. Okay, here we go. Powering people. Got it going. Okay, obtaining credit in the current market environment. I'll skip past this here. So introduction, I went over myself, and Christine can go over a little bit later. So some of the main factors here affecting credit eligibility are historically low, and this is going to be the majority of what I'm going over here. Historically low unemployment, stubbornly high inflation, rapid ascent in interest rates. We've got a slowing economy that everybody's talking about. And then on top of all of that, we have tightening credit requirements. And if that isn't enough, then we've also have to try and stabilize or work with our financial statements in order to mitigate the effects that we saw during the pandemic on our financial reporting. So those are all things that I'd like to quickly kind of go over with as far as the economy is concerned, and then get into really the specifics around financial reporting. So this is the current landscape. I love Yahoo Finance. I think they have some really beautiful charts. All of this stuff is from the government, so you can get Bureau of Labor Statistics or the Fed, the Federal Reserve, but they put it together in very pretty charts here. So quickly, the reason why I want to talk just high level about first unemployment and then inflation is because those are the two primary factors that determine what the Federal Reserve, who sets interest rates, those are the two primary factors that they look at. And so while I'm not an economist, and the majority of our credit administration and sales folks are not economists, and we don't try and predict what's going to occur in the future, we do think it's a really good idea to have a strong understanding of what is occurring currently in the environment, financial environment, and then what's also occurred over the last 12 months. And the reason for that is because credit, while we don't need to really know what's going on in the future, we take a pretty conservative approach. So if we're seeing something historically, it's more likely than even if it looks a little bit better in the future, we're probably going to maintain that more conservative structure. So what we're seeing here is a really strong employment market. We've had record low unemployment. It's been down to 3.4% a little over a month ago. 3.7% is the most current reading. 3.4% is an all-time low. It's absolutely amazing. Quickly on the inflation piece, I don't want to get into this, but you can see, I just wanted to show that there's a huge, just to hear overall inflation of 4.9%, which is what it was last month. We just had an update on inflation today, actually, and it came down a little bit lower. It went from 4.9% down to 4% year over year, which was a fantastic decrease and was in line with economists' expectation. But if you look at the overall inflation of 4.9%, you can see there really is a huge discrepancy on what's really being affected by inflation. And so I want to do that. I want to show that in conjunction with another item. So just say this is across the board. The economy is feeling the effects either positively or negatively to the extreme. And again, that leads into a credit environment that can be a little bit more restrictive. So the next slide that I want to go over here is just, it's kind of an interesting take on interest rates. So what you can see here is the red line is short-term interest rates. And so typically you would expect that short-term interest rates will always be less than long-term interest rates. And that's just typically how it's been, because you've got inflation, and so the value of your money is less. So you'd expect a higher return. Sometimes that inverts, and it's inverted when short-term interest rates exceed long-term interest rates. This is a very difficult environment when this occurs. It has not occurred very often. It typically occurs when there's a recession. What you see in the gray here are recessions. This is a pandemic related. And you can see when these rapid increases occur, they go up to parity with the long-term interest rates. In this case, we have exceeded that. So our long-term interest rates have completely decoupled. I'm sorry, our short-term interest rates completely decoupled from our long-term interest rates. Again, this is just another way of looking at it, where you take long-term interest rates and then you minus out short-term interest rates. This should always be above zero. When it drops below zero, it means that short-term interest rates are exceeding longer-term interest rates. Okay, well, so why does that matter? Because we're not economists. Oh, sorry, here's the gross domestic product. This is just a chart that's absolutely amazing. You can see our gross domestic product with the pandemic dropped down to about 30% negative, and it jumped up to about 30% positive. So we're back to that trend line, and things are stabilizing. We're starting to have that outlook. So tightening credit environment. So that's the biggest piece here, is we have a tightening credit environment. We see it across the board. And the primary driver of that is interest rates, the uncertainty around interest rates. And I'll get into the specifics around exactly what is contributing to that here. But one thing is clear with this is all C&I loans. This is all commercial business loans that are out there. Well, you can see in this chart here, this is the PPP funds that went out. It's an astronomical amount of money that went out, and then it was all forgiven. And then people have started to draw up on funds outside of government stimulus. So we're starting to approach the debt levels that we were seeing in the pandemic. So debt has been out there. We've done a lot of it. And so that's where we're expecting some of this pullback. Okay, so let me move on here. So what's the problem with short-term interest rates exceeding long-term interest rates? Okay, well, the primary issue is that financial institutions, as a general practice, borrow on short-term interest rates, and then we lend on long-term interest rates. So when we're borrowing, it's typically in deposits, and we're paying you in the deposits. So we pay you 2% on a short-term basis, and then on a long-term basis, we'll make a 5% loan. Well, the problem with that is when you have an inversion in the yield curve, you have short-term interest rates, which is basically our depository rates, exceeding what we can lend at. So on day one, on a lot of commercial loans that we're seeing, is we're having to borrow at 4% to 5%, and we're lending out at around 5 to 6%. A normal margin for a bank to make money is about 2%. So in a lot of cases, banks right now, if they are lending, because they have to continue to lend because they always will have deposits, it may be less, but it's a lot more challenging than it was historically here. And so let's see here. So why? So that being said, so there's just very little incentive for banks as a whole to go out and be extremely aggressive in this market, because they're booking loans right now at either break even or a loss. So is all hope lost? In my opinion, no. So financial institutions still need to lend, but it's more difficult. So we really need to be prepared when we're seeking credit. So now I want to go through a couple of things that I see from the credit side that would really help out clients. So the biggest one is addressing the pandemic effects on the borrower's financial statements. So typically, when you're presenting to credit, and I know Christine's going to go over this, you're going to put together a package. And one of that piece of that package is going to be 3 years of financial information. That could be tax returns or internally prepared financial statements. That's pretty much a standard. Well, I would go farther than that right now because it's an unusual environment. And because those 3 years encompass 20, 21, and 22, those are not representative of your business. So you may have recovered a little bit faster than some others. You may still be recovering. So take a look at what you're doing in 2022 and take a look at what you're doing historically. Um, and then try and find a way to normalize that. So one of those things, so far as normalization, is trend analysis. So when we receive, so there's 5 years, so put together 5 years, present it to credit, whether it's asked or not. I think it would be behoove you to include 2018, 2019 to show this is how I operate historically, this is how I can operate in the future. Trend analysis is another thing. Once you compare and you put those 5 years together, look across. This is very common for underwriting. Look across each line in those line items and look for large or small decreases that are occurring. Anything that's large, you're going to want to address that right away. And really what we're trying to do is do a lot of the work for credit on the upfront so that it's harder for them to get to a no. So we want to prepare. So one of those is that taking over the analysis that they've got is to do this trend analysis by putting out 5 years, taking a look at it. And with that kind of ties into this big little analysis, which is one of my favorite, was when you go across that trend, if there's something that stands out, like it's a 20% jump from one year to the other, call that out. Tell us why it is. Explain. It's an opportunity, that may have been a really good thing. For example, you could have a temporary increase in rental expense from one period to the next. Explain to your credit administrator, is that your lease renewal? Is it going to continue to go on at that level, or will it revert back? Or is it TIs that you expensed instead of capitalized? And those are coming through your statements. And you want to clarify that. Well, I could have capitalized this, but I expensed it. The next thing that I think is very, very important is, and I know Christine's going to get into this, is pro forma and projections. If there's really anything I could tell you right now that I think you should spend some time on, is preparing pro forma statements. So that means basically normalizing your historical financial statements. So when you go back and you look at your 2018 and 2019, see if you can come up with reasons why during that 2021, 2020, 2021, even into 2022, of normalizing that, and assuming that you can break out pieces of that pandemic, try and normalize it to show a consistent operations over that time. It is going to be very difficult, but it'd be a good thing to start on and think about. The next thing is projections. Typically, I wouldn't ask for projections, but in this case, I wouldn't even wait for it. I'd put together 1 year of projections in order to have that, and just send that off, and then put in any type of variables of what your exceptions are. So I'm starting to run out of time here, and I want to save time so we have Q&A here, and I'll pass it off to Christine here. But I just want to say one last thing here, and be prepared to show everything. Don't hold your cards. This is not the time to do that, right? You want a partner. So you go to your relationship manager, to your business making partner, and you build that rapport with them. You put your cards out on the table and you talk to them like a human being, right? And you got to expect that they need to know the downsides and the upsides of it, and you need to have that relationship. Furthermore, be expected to post collateral. And lastly, be expected to post a personal guarantee. It will occur in this environment. So I know it's difficult, but from a bank's perspective, we like it just to say, hey, I know you're going to come into the office, and that's it. So anyways, with that, I thank you for your time, and I'll be here on the Q&A, and I'll hand it off to Christine.
Great. Thank you so much, Danielle. That's such good information. Regarding, what businesses need to expect on the outside. So what's happening in the economy and how that's going to affect their ability to qualify for commercial lending. So I'm going to be talking about a little bit more and emphasizing some of the things that Daniel has already said. And by the time we're finished tonight, you're going to be tired of us saying prepare. But that is something that a lot of us have learned as business owners during the pandemic. That preparation really saved a lot of us. So my name is Christine Buckley. I am the director of the Loan Readiness Center at Business Impact Northwest. I'm also a business owner. I'm a certified business advisor, certified credit counselor, and a licensed mortgage loan originator. So I've been working with small businesses for quite a while. I did things wrong when I started my own business. So now I am working for an organization that is a business service organization, and we partner with lenders such as BECU to help businesses who have traditionally faced barriers in accessing funding. We are trying to help lower those barriers, and we do that by providing advising and workshops and educational opportunities. So, first things to think about in qualifying for a commercial loan, you really want to think like a lender. So, you want to put yourself, whether you're a startup, whether you've just been going for a few years, or you're an established business looking to grow, think about what a lender is looking for, really. So, put yourself in the shoes of a lender as if a friend, family member, another business came to you asking for a loan. You want to get repaid, right? So you're going to be asking questions. So I work with businesses. And it's like, why does the lender ask for so many documents? Why do they want me to have a really solid loan proposal or business plan? They need that information to be able to make a decision whether or not you're going to repay the loan. So, first of all, be able to demonstrate your need and purpose. How is this injection of capital, or what I call fuel for your business, going to help your business? How is it going to strengthen your business? How is it going to help your business create more revenues? And some lenders, such as some credit unions, some banks, such as Business Impact Northwest, we are a community development financial institution. We're also looking, and we take into account your impact on your community. So, is this injection of loan amounts, loan and capital, going to create jobs in your community? Is it going to help fulfill a need that your customers and clients have in your community? You also want to let them know what you're going to be using it for. So, are you going to be buying equipment? Do you need it for supplies to fulfill a contract? Do you need it for operating costs or working capital, such as hiring a new employee? They need to know that because they want to know where their money is going to go and if some of that loan is going to actually be used for collateral. Know ahead of time what your risk factors are and show that you are a good risk. So, if you are a startup, that obviously is a risk factor, but how do you mitigate that? Have you been taking business classes? Have you been getting a lot of experience in the industry? As Daniel mentioned, have your documents ready to support your application. So, a lot of things that we do at the Loan Readiness Center is help small businesses get those documents ready. And it could be historical financial documents, or it could be those projections or pro formas ready as well. One of the main things I see in businesses that are looking to apply for credit is that they really haven't gotten their documents in order. They're not exactly sure where they are. They have to reach out to their accountant to get a copy of their tax returns instead of having a copy on hand themselves and knowing what is in those documents. Some businesses, their accounting systems are not as robust as they could be, meaning it might take them a month to get their books reconciled before they can um, produce those financial statements. So be sure to have everything at hand and ready and up to date. And then again, know what the lender looks for and what they are going to need from you. And that will lead me into what's called the 5 C's of credit. Um, and these are things that will help a lender determine your risk. Some lenders weigh one or more of these more than another. For example, some lenders will look at your character, which is also your credit history, more seriously than others. So some lenders you may find that they will not take a credit score under a certain threshold. Others will take the whole 5 C's and look at all of them in conjunction. So, the first one to talk about is your credit score. And your credit score, I'm going to be talking about your personal credit score, which, as most of you know, is monitored by three credit bureaus: TransUnion, Equifax, and Experian. And those scores typically run between 0 and 800, and a good average would be between 690 and the low 700s. Business credit score, on the other hand, are monitored by Equifax Business, Experian Business, and Dun and Bradstreet. And they have a different scoring system, and that is between 0 and 100. Just a note about credit scores. You may all be able to get your credit score from your bank. You may have an app on your phone. You may have Mint. Just be aware that some of those credit scores will vary from what you may get or the lender may pull from one of these three bureaus. And it's just because of the timing that creditors are reporting to these bureaus and how that timing works with that score. Lenders typically look at your personal credit score, and vendors and suppliers are looking more at your business credit score. One big question I get a lot is why would, if I'm applying for a commercial loan, not a mortgage, why do they want to know about my personal scores? Well, they're looking at the character, the history of repayment of the business owners, and they are the ones that are making the financial decisions for the business. So it just makes sense that if they have good credit, that's going to reflect on their finances in their business as well. Collateral. Daniel mentioned this. So, collateral, what is collateral? Collateral are assets, and that could be in the form of equipment, buildings, real estate, accounts receivable, and in some cases, inventory. And this is considered a possible source of repayment or backup for the loan in case the borrower defaults. And this can be sold by the bank for cash. And it can be also include business assets or collateral or personal, and that's where that personal guarantee comes in. Most lenders are going to want a 1-to-1 ratio, and what do I mean by that? So, for example, if you are asking for a $100,000 loan, they're going to need $100,000 in collateral. So, you want to be prepared to have a list of your personal and your business balance sheet where those assets are going to be listed and their value. To be noted on that is that a bank will not consider the market value that you list. They cannot take 100% of that. So again, if you own a truck in your business worth 100,000, you're looking for a loan for 100,000 to perhaps buy another truck, um, they will not look at that truck as 100%, maybe 50% of the value that the bank can take. So they're going to be looking for another 50,000 somewhere in collateral, and that could be on the personal side as well. How much capital? Again, this is always a big question. It's very rare that you're going to get a 100% financed loan. So, again, in the example of buying a truck, the truck or the project cost that you need funding for has an amount. You need to know what that amount is. In this example, it's 100,000. So you're going to need most likely minimum 10% to maybe 20% down, depending on the lender, depending on your risk. And they're going to need that at the time of the loan. So in this example, 100,000, you're going to need 10,000 to put towards the project. This is called, as you may have heard before, skin in the game. Your part of this project is that 10,000 and the bank is going to put in the other 90,000 towards that project. So how much depends on the loan size. The larger the loan, they may, start asking more towards 20%. If it's a smaller loan, they may feel comfortable with just 10%. Capacity. Daniel mentioned this as well, and this is shown in your business financials. So this is the demonstration of enough revenue to support your operations and your debt, existing debt, and any debt that you are looking to apply for. This is shown on your financial statements, so on your balance sheets, your income statements or profit and loss, tax returns, and those cash flow projections. Now, Daniel brought up a really great point about what these financial statements may be reflecting in 2020, 2021, 2022, and the importance of also putting together a cash flow projections. So for businesses that their financial statements are not looking really robust because of that, or businesses that don't have a track record, a revenue, or anything on their finances, a cash flow projection is going to be critical. So this is really, really important that you also show what's going to happen with the injection of this new loan. So, how is that going to affect your finances and especially your cash flow? I also recommend that businesses get in the habit of knowing how to put together a cash flow projection, at least for the next 6 months. You always want to know where you're going to be in the next 6 months. Cash flow projections, often in the form of an Excel workbook, are a really amazing and powerful management tool for businesses, not just for applying for a loan. On top of capacity, you're also going to have to demonstrate the conditions. So, what are the conditions that your business is operating in? What's going on in the market? What are the industry conditions? Are things getting better, getting worse? What are the capabilities of the management team? So those are the owners and the key employees. What do they bring to the business that is going to make this revenue stream that you're proposing or you're wanting to maintain? What do they bring to the table? So what are their specific skills and capabilities in that industry? You'll want to also have your marketing and sales plan written out. And one thing small business owners often do not consider is the risk mitigation plan. It's really important for a lender. So if you propose that you're going to increase your sales by X amount, and you've provided the research, the backup on that, what if you don't? So what's your plan? The lender's going to want to know, okay, what's my plan to, in case we don't meet those sales and we don't have the cash flow to pay back the loan. So getting ready for the loan proposal. These, in summary, are the things that I've already discussed. Your specific loan purpose. What's your project? How is it going to help your business? What is the exact loan amount? So you'll have to know what you have available in capital, what percentage, how much you have available to put towards that project, and then what that loan amount would be. You may want to start researching different types of loans. So, different lenders have different types. A lot of lenders have the same type of term loans or SBA loans, but also they may have some specific or specialized loan products. For example, we have an I-10 loan. We also have a Sharia compliant loan. So you might want to start researching that and also discussing that with your banker. Really important to have a really good, as Daniel mentioned, really good communication and relationship with your banker. You also want to calculate the length of repayment. So obviously, if it's a larger loan, you'll need a longer length of repayments. Specify the use of the loan funds. Estimate the funds that you're going to have or you have in your bank and other accounts such as retirement. Also, they may be wanting to know what your monthly salary and any other income is. And that is really for the lender to know um, what secondary income might be available to repay that loan. So again, the lender is really their main concern is your ability to repay. And as I've demonstrated or as explained with the 5 C's, what they're looking at in those things and in your documents is, do you pay back your loans? That's going to be shown in your credit report. Have you been successful? What's your track record? Or have a good case that you will be? How are you going to generate the cash to pay back the loan? Is your industry going in decline? What is the demand for your products and services? And do you have some research or a track record to show that? And do you have assets to back up the loan? So, finally, I just want to emphasize there are so many resources available to small businesses, either for free or low cost. And really, it is worth the time to meet with an advisor, meet with your banker, sit down and discuss your needs as a business owner. And Daniel, did you want to talk about the relationships that we have with you and our scholarship programs?
Yeah, you can cover it if you're able to.
Yeah, absolutely. So BECU and Business Impact Northwest have partnered. And really, what we are looking to do is support and grow businesses financially so that they are successful and sustainable. And we do that through a BECU sponsors scholarship program for BIPOC, women, and veteran owned businesses. And there are two options for courses. One is the Launch and Grow class through Business Impact Northwest, which is a 7 week course. This is more geared towards startup businesses, and it goes through all the main factors that are included in a business plan. So by the end of this course, you will have the foundations of a business plan, and that will really, and your financial projections, and you'll be ready to present that to a lender. Also, we have Grow and Thrive, which is a 12-week course, and that course is geared towards established businesses who are really ready. They've foundation, they've got 2 to 3 years maybe of operations, and now they're ready to go to the next step. And you can see on your screen how you can go about applying, and that's at becu.org/business impact northwest. And a little bit more about Business Impact Northwest. Again, we're a small business service organization. We're also a nonprofit community development financial institution. We've been operating in the Pacific Northwest since 1997. We serve Washington, Oregon, Idaho, and Alaska. We have lending in Washington, Oregon, and microloans in Alaska. So, really, our mission is to grow businesses that create jobs in underserved communities. And we believe that all business owners should have an equal opportunity to succeed and contribute to their own livelihoods, their own families, and their communities. And we do that with integrity, community, inclusivity, and we really celebrate the success of small businesses. At Business Impact Northwest, we really have a lot of programs to serve our businesses. So, as you have heard, we have the Loan Readiness Center to get you prepared to apply and qualify for a small business loan. We have this Food Business Resource Center, and that's geared for businesses that are either producing or manufacturing or delivering food products. We have the Veterans Business Outreach Centers. Those are serving our military communities, so veterans and their spouses. We have two women's business centers, which are partially funded by the SBA, one in Washington and one in Alaska. And we also have the Minority Development Center in Oregon. So lots of resources for businesses to take advantage of. So now I think we're ready for some Q&A. I think there's some questions in the chat.
Hi there. Yes, we do have some. I know that you guys talked about qualifying for a loan, and one of the questions that member had was, what are some of the main reasons that they would get denied for a commercial loan for their businesses?
Sure. Christine, you want to take that, or would you like me to?
Yeah, I can start off. Yeah, there's a couple of things that will stop businesses in their tracks when they go to apply. Number one is credit score. Especially, I've seen that more now because of the pandemic. Unfortunately, a lot of individuals and businesses did take a hit and were maybe having to delay payment of some of their credit, and that affected their credit score. We do have credit counseling at the Loan Readiness Center for that. The other big one is lack of collateral. So businesses really want to think about saving. If they're thinking of getting a loan, thinking about and preparing for that 10% to 20% down payment.
Mm-hmm. Yeah, and from my perspective, that was great. One of the biggest things that will sabotage a loan right away is non-disclosure. Credit hates surprises. I don't care what it is. We get so much background information. The credit reports that we pull are beyond anything you would ever see. So they can go beyond 7 years. So if you've got an issue that has occurred in the past that has involved a financial institution or a payment of some kind, and it may or may not show up, it will behoove you to prepare for that conversation. And if it is really glaring, you will want to bring that up before it is found, because if they find it, it is over. They're not going to have that discussion with you anymore, even if it's really not that big of a deal. So disclosure, no surprises. That's number one.
Yeah, that's true. Yeah, and so yeah, absolutely. Know what's on your credit report before the lender does, and make sure that you do. If there's anything on there that doesn't look right, you need to get that cleaned up. Or if there's something that, let's say, something's gone into collections, they're going to see that, and so there are things you can do to maybe start paying that or getting it out of collections, paying it off before you approach a lender. Everyone is entitled to a free credit report, and you can get that at annualcreditreport.com.
All right, we are nearing the end here, but let's do one more question for you guys. Sure. What is the benefit to separating my business and personal loans when I'm a small company? And do I have to have a personal guarantee on a commercial loan?
I can answer that. Yeah, so you absolutely want to separate your business operations from your personal operations. There are legal reasons why, and I won't get into that. There are tax reasons why. Well, I will not get into that. But more importantly, you want to show that at some point in time, this business will operate independently of yourself. We are lending to this business. You are the secondary that we're looking at as the guarantor. So we do not want them merged together. It is very difficult for bankers to go in and figure out where money's going back and forth, and for you to actually clarify it for us is just too much. So it complicates something that does not need to occur. And that personal guarantee, yes, you will absolutely have to guarantee. I've dealt with 100 millionaires that will sign a personal guarantee on it. Some do not, but it is an extremely common thing, and that gets you the best credit terms. More importantly, when you get in trouble, they're going to work with you more because they have that personal guarantee than if they didn't. That's it. That's the number one.
All right. Well, thank you for all of that. We are at time, so if you guys want to do a quick wrap up, then we can head out.
Sure, and I'm always available. I'm on our BECU website, but and you can always send me an email. Give me, I think my cell phone's on there. So if you have any questions about credit or sales or the Fed, give me a call. I'm around. So
Yes, and I would say likewise. Don't hesitate to reach out to your banker, to BECU, to Business Impact Northwest. We're located at businessimpactnw.org.
I appreciate it. Thank you so much.
Thank you.